Welcome to vTalkInsight, Risk Sentiment Daily for March 17, 2026. Middle East supply shocks, shifting rate expectations, and rising credit stress are colliding with surprisingly resilient U.S. equities and an ongoing AI boom. Today we unpack how those forces are reshaping risk appetite across assets and what that balance of fear and optimism means for positioning. Risk sentiment sits in a cautious, two-way zone, rather than a clean risk-on or risk-off regime. The dominant backdrop is still defensive, driven by the Middle East energy shock and elevated volatility, yet investors are not capitulating and remain engaged in selected areas, such as U.S. equities and AI-linked technology. The largest weight on sentiment comes from the ongoing disruption around the Strait of Hormuz and attacks on key Gulf infrastructure, which have pushed Brent crude above $100 and created what many describe as the largest oil supply shortfall in years. This is feeding a stagflation narrative, with higher fuel, power, and input costs squeezing European industry, airlines, and consumers, while also lifting inflation expectations and policy uncertainty. Against that backdrop, risk appetite shows pockets of resilience. Global equities are on track for their weakest month since late 2022, but the S&P 500 has been comparatively resilient, even rising about 1% in the latest session as volatility eased from recent highs. Flows highlight a clear preference for safety and liquidity, more cash, gold, and a stronger dollar. Yet institutional investors are generally staying in the market, tilting toward defensive sectors, U.S. exposure, and quality franchises rather than exiting risk altogether. The Middle East energy shock and stagflation risk remain the primary bearish driver for risk assets. Attacks on ports such as Fujairah and ongoing conflict around the Strait of Hormuz have sharply reduced shipping traffic, contributing to an estimated oil supply deficit of 10 to 14 million barrels per day and pushing Brent comfortably above $100. With intraday swings between 85 and 120. Scenario work now openly contemplates oil at $150 within weeks, and even $160 to $200 if disruption persists, levels that several analysts warn could tip the global economy toward recession. Europe looks particularly exposed, with soaring gas and power costs pressuring steel producers, airlines, and energy-intensive industries, while higher jet fuel and fertilizer prices risk feeding through into ticket prices and food inflation, reinforcing a stagflationary mix. There are partial offsets. Some Iranian and Russian barrels are still reaching markets via waivers and stored supply. Strategic reserves provide a temporary buffer, and the U.S. economy is deemed less vulnerable thanks to energy self-sufficiency and a strong dollar. Even so, geopolitical risk premia on commodities are rising structurally as countries shift from just-in-time to just-in-case inventories. The key watch points are further attacks on Gulf infrastructure, any progress toward reopening Hormuz, and how long oil stays above $100, because the longer this persists, the more pressure builds on both growth and valuations. Higher for longer rates and policy uncertainty are the second major headwind. The energy shock arrives on top of already sticky core inflation, particularly in services such as healthcare and education, and markets have moved to price either very few, or in some cases no, rate cuts, with pockets of renewed hike risk in certain economies. Central banks face a difficult trade-off. On one hand, disrupted oil flows and surging jet fuel and electricity prices threaten another inflation spike, with some estimates suggesting headline inflation could be pushed up by around 0.5 to 1 percentage point. On the other hand, weaker labor data, softer German industrial production, and trimmed global growth forecasts highlight rising downside risks. As a result, institutions like the Fed are expected to raise their inflation outlook while cutting growth projections, and to stay on hold rather than delivering the cuts that were priced earlier in the year. Yield curves are flattening as front-end rates adjust more than long maturities, reflecting expectations for weaker forward growth and only gradual disinflation, a configuration that tends to pressure traditional 60-40 portfolios. The counterview is that markets may now be overestimating how far European and UK central banks can tighten, given negative data surprises and the absence of the kind of massive fiscal or monetary impulse that drove post-pandemic inflation. Shelter inflation is also expected to moderate as rents have been flat nationally, which could help core measures later this year. Incoming central bank communication, including from the Reserve Bank of Australia and the Fed, will be critical for clarifying whether this higher-for-longer narrative is peaking or just beginning. Private credit stress and liquidity risk form the third key bearish driver in the current environment. Redemption limits and gating at some large private credit vehicles highlight a structural mismatch between illiquid assets and investor liquidity expectations, raising the prospect that pressure in these channels could spill over into more liquid parts of the market. One concern is that investors needing cash may be forced to sell listed high-yield bonds or equities, even if the underlying issue is in private markets, leading to sharp price gaps and the kind of discounts to net asset value that high-yield exchange-traded funds have seen in past stress episodes. High-yield credit derivatives are already being used more actively for tail protection, with notable short positioning, and credit spreads have widened as risk premia rise alongside geopolitical uncertainty. There is, however, a more constructive interpretation. Increased scrutiny, better transparency, and more conservative underwriting standards in private credit could ultimately leave the asset class healthier, and so far there are few signs of systemic stress in banks or investment-grade borrowers. The balance for portfolios is that liquidity risk is being repriced, favoring higher quality, more liquid credit, while leaving levered or opaque structures vulnerable if volatility spikes again. Watching fund gating, high-yield spreads, and flows into defensive assets such as gold and the Swiss franc can offer early signals of whether this remains a contained adjustment or evolves into a broader credit event. Offsetting these headwinds on the bullish side is the AI investment boom and continuing tech resilience. Projected AI infrastructure spending is now discussed in trillion-dollar terms over the coming years, driven by rapid adoption across enterprises and consumers and by heavy investment in data centers, connectivity, and power infrastructure. Semiconductor leaders such as NVIDIA and Broadcom are still posting growth rates above 30% annually, even as sector valuation multiples have compressed, making technology look more reasonably priced relative to its earnings trajectory. NVIDIA, in particular, has reportedly secured over 60% of AI chip supply capacity for this year through long-term contracts, reinforcing its market dominance, while recent easing of certain U.S. export restrictions to China could add upside if management signals improved revenue visibility from that market. There are important caveats. Rising energy costs and tighter credit conditions are pushing technology and AI companies toward greater efficiency and more disciplined capital allocation for data center buildouts, and markets remain wary of a tech-led drawdown if growth disappoints. Even so, robust earnings expectations, cost discipline at major platforms, and strong demand for companies positioned as AI beneficiaries or resilient to disruption are supporting a structural growth premium. The next signals to watch are guidance and backlog comments from leading chipmakers, CapEx plans for digital infrastructure, and how sensitive these names prove to further spikes in funding and power costs. The second bullish driver is resilient U.S. equities and quality risk-taking. Despite global indices experiencing their weakest month since 2022, the S&P 500 has only seen modest declines and recently posted a gain of around 1%, signaling that investors are trimming risk rather than abandoning it. Equity exposure is generally favored in the U.S. over Europe, reflecting the U.S. economy's relative insulation from imported energy shocks and the continued strength of its technology sector. International equities, especially in Europe and some parts of Asia, are viewed as more vulnerable to sustained high energy prices, while emerging market debt remains interesting but highly dependent on country selection and fiscal discipline. Positioning data point to higher cash balances, more demand for protection, and a tilt toward defensive sectors and well-understood companies, even as some investors look to exploit dislocations in fundamentally strong names, particularly around AI-related catalysts. Key signposts here are the breadth of any U.S. equity rebound, earnings revisions for quality franchises versus cyclicals, and whether rising credit and energy costs start to undermine the resilience that has supported U.S. risk assets so far. The third supportive driver is energy transition and renewables growth tailwinds, which provide a long-term counterbalance to today's fossil fuel shock. In Europe, wind and solar generation has already surpassed all fossil sources combined, and onshore wind capacity is expected to quadruple by 2050, underscoring the scale of planned investment in low-carbon power. Policymakers are increasingly focused on reinforcing cross-border electricity grids to better balance regional production and consumption, while efforts to reduce dependence on external energy supplies add strategic urgency to domestic renewables, storage, and transmission projects. Rising electricity prices linked to higher oil and gas costs can, paradoxically, boost revenues for renewable producers and grid operators, even as they pressure heavy industry. There are non-trivial risks. Supply chain disruptions from the Iran crisis could, if prolonged, raise equipment costs or delay projects, and local opposition and regulatory bottlenecks continue to slow infrastructure and data center development in parts of Europe. Nevertheless, the direction of travel is clear. Structural capex into renewables and grids is likely to persist for decades, offering a differentiated, policy-backed growth stream within an otherwise volatile energy complex. Monitoring permitting reforms, project timelines, and input cost inflation will be key for gauging how investable this theme remains in the near term. To sum up, today's risk backdrop is defined by tension between a powerful Middle East energy shock, higher for longer rate fears, and emerging credit stress on one side, and the resilience of U.S. equities, a multi-year AI investment cycle, and enduring energy transition tailwinds on the other. That mix argues for reading price action through the lens of risk premia and regime shifts, not just short-term headlines, and for watching a handful of critical signals: oil supply routes, central bank language, credit spread behavior, and whether quality growth earnings continue to hold up. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.